And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get the day underway and the week, first trading day of the week, because yesterday was obviously a holiday because of MLK Day. So a lot of things to get into this morning, talking about a couple of things. One, the pain trade is higher. That's the name of an article that is on our website as well today. So a little bit more discussion than we'll be able to get into this morning on why the pain trade is higher, with a lot of attenuating charts as well. So that's always on our Tuesday blog. But go to the website, realinvestmentadvice.com, and you can get that blog to go along with your daily reading to go along with our show. Also, we'll talk this morning a bit about the national debt, right? So the debt keeps going up, just past 1.7 trillion, continuing resolution. Unfortunately, what they forgot to do when they passed that continuing resolution in December to fund the government was to raise the debt ceiling. So that is now the next big conundrum for the markets. It's like, oh my God, where's the debt ceiling? We've been here so many times before. Look, here's my thing about the debt ceiling. Just very quickly. If you're not, the reason you have the debt ceiling is it's like a credit card spending limit. So the point is you're not supposed to go above the debt limit. When you get to the debt limit, you're supposed to go, oh, well, maybe I need to cut some spending. But if you're not ever going to cut spending and you're just going to keep spending, just get rid of the damn thing. So, I mean, if you're not going to pay attention to it, just get rid of it. I mean, the debt ceiling was there for a reason, and we just keep raising the debt ceiling. We've raised it every time. I think we're up to like 24, 25 times. You can correct me if I'm wrong, but it's a lot. But going back to the 1980s, we've been raising the debt ceiling consistently as we continue to spend more and more money and go deeper and deeper into debt. So that's the big next hurdle for the markets. Are we going to raise the debt ceiling? Yes. Is there going to be some political theater over it? Probably. But at the end of the day, it'll get passed. We'll keep going on. We will survive. And just let me say one other thing. A government shutdown is not a terrible thing. We've done government shutdowns before, and guess what happens? We lay off 950,000 non-essential workers. By the way, if you're classified as a non-essential worker, you may want to consider a job that's essential. So the second thing with government is that if you have 950,000 non-essential workers, maybe that's where we need to start cutting the budget. So if they're not essential, you probably don't need them. So we could probably save some money there, and a good bit of it. But yes, we close down parks, we close down other things. Now, what you'll hear in the media is like, oh my gosh, though, if we shut down the government, Social Security won't go out. Yes, it will. Military officers won't get paid. Yes, they will. Those are mandatory spending. Mandatory spending gets paid regardless of what's going on. The government shut down, not shut down, mandatory spending gets paid. Whoa, another thing you're going to hear, of course, is, oh, we're going to default on our debt. No, we're not going to default on our debt. We have what's called a printing press, so we can always meet our debt obligations. It's always these big stories in the headlines, but let's just keep it real. The government's going to raise the debt ceiling, and we're going to go on with life. So it's not that big of a deal. What is a bigger deal is the debt. And lots of articles out over the weekend, videos, things coming out about the surging debt because, again, now we've crossed $31 trillion. We're rapidly heading towards 32. We keep spending more and more money. In fact, we're running a bigger deficit run this year than we did in 2022, which is hard to imagine. But nonetheless, it's the end of the world coming as we know it, because eventually we're all going to default and die. No, that's not the case either, but we'll get into the importance of debt this morning as well on the show, so we'll talk some more about that. Very quickly, though, markets are doing very well here as we enter into the middle of the month. And on last week, the market rally has continued that started at the beginning of the year. Again, we'd said before that January is the largest amount of inflows into the market of the year. Of all other 11 months combined, you have the most money coming into the market in January. Been very clear here, markets not only broken above important moving averages, we did break above the 200-day moving average, So we're starting now a little bit of a sell-off this morning. Won't be surprising. Come back, we're going to have to kind of work between this 50-day, 200-day moving average a little bit first, potentially then move above that if we're going to continue this rally here over the next month or two. Again, we're in the seasonally strong time of the year right now. MACD buy signal still in place, suggesting that asset prices can move higher here. Markets are not extremely overbought. They're a little bit overbought short term, but markets can be overbought for a while on a short term basis as you're in the middle of a rally. So again, this rally continues. We added some exposure early last week. We're going to continue to kind of work the portfolio here over the next few days, but we are definitely seeing a rotation back more towards that bullish mindset in the markets. Now, as we've said before, it's exactly not what the Fed wants, because consumer confidence is improving. The University of Michigan Consumer Confidence Index came out on Friday. That showed improvement. People are being more confident. Rising asset prices, falling inflation, giving consumers a bit more confidence about the economy. Well, that's exactly not what the Federal Reserve wants. The Federal Reserve wants consumers to be more gloomy because they need them to contract in order to get inflation down. So this is so this rally is working exactly against what the Fed wants. So now we've got an FOMC meeting coming up right at the beginning of February. That's where the Fed will hike another 25 points. One of the issues potentially here now that we're watching is this going to be the Fed's last rate hike? Nick Timros, Wall Street Journal Fed Whisperer, came out and said that most likely we'll see a 25 basis point hike at the next meeting, and that could be it. So we'll see. Now, the 2-year Treasury rate is an important thing to watch because it basically leads the Fed funds rate. The 2-year Treasury rate has already declined to about 4.9%, suggesting that the Fed won't be able to get to their 5.25% that they've been talking about. So again, this is why one more rate hike. The 2-year Treasury is also saying one more rate hike, and potentially the Fed is done on hiking rates. Again, one of the things that has been supporting the market actually all year, last year, was this hope of this Fed pause, right? The Fed will stop hiking rates. That'll be good for stocks. That's part of this rally as well. Now, as we talked about in this past weekend's newsletter and in today's blog as well, which is an expanded version of what we touched on in our newsletter, we are forming this higher base of bottoms in the market. So that is bullish here. Again, a lot of bearish sentiment in the markets right now. A lot of people kind of really off sides, a lot of cash holdings for individual investors. Once this rally starts to get going here, that's going to start pulling more and more money off the sidelines into the markets, would suggest that this rally does have more room to run. So give it a little bit of room to operate here. Again, I'm getting a lot of emails about this being, we're still in a bear market. It's going to crash. We're going to go lower this year. Be careful with that because, again, markets can do exactly the opposite of what you think they should do at times. And again, remember, the market's been pricing in bad news now for a year. All of last year, it has been one story after another about inflation, market crashes, recessions, all those type of things. Market has been doing a job of pricing all that in. Earnings, of course, that starts today, really in earnest. We started a little bit last week. Goldman Sachs, Morgan Stanley, others all reporting earnings today. We're going to really get into the heart of earnings next week. Now, the important thing to pay attention to here in regards to earnings is not what they say. They're going to beat earnings estimates. They'll meet or beat them because we've lowered estimates a good bit going into earnings season for this quarter. What's going to be important is what they say about the rest of the year. Lots of stuff to get into this morning. We'll come back, pick up with the pain trade is higher for now, right after the break. RealInvestmentAdvice.com.
Get daily investment news you can use, delivered at the speed of the internet at RealInvestmentAdvice.com.
Housekeeping.
Getting your financial house in order for the new year need not be a tedious task. Our next Candid Coffee will get you ready for the fiscal roller coaster 2023 promises to be, with financial tips and talk. Saturday, January 28th with Richard Rosso and Danny Ratliff. Register now at RealInvestmentAdvice.com. The Financial Housekeeping Candid Coffee with Ratliff and Rosso. Register today at RealInvestmentAdvice.com. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is, of course, Tuesday as we kind of go through the month of January already, kind of ticking by here. Before you know it, it'll be April the 15th, time to pay taxes. So we'll see when we get there. We'll have a lot more to talk about on taxes as it comes. Anyway. Couple of things. One, our new article is out this morning. It is called "The Pain Trade is Higher for Now," and a couple of reasons. I touched on this topic in this past weekend's newsletter as well. So, by the way, just a quick housekeeping before we get into this. A few changes here on the site, and we'll keep reminding you here if you're looking for things. We have a new YouTube channel for what's called now Before the Bell. It used to be our 3 minutes on markets and money. We've separated that out. We now have Before the Bell, which is our 3-minute video kind of pre-market trade setup, what to be looking for the markets for the day. That now has its own YouTube channel, so you'll need to subscribe to that so you'll get notified. We're breaking these things out so you can kind of select your subscriptions, right? So you have the full Real Investment Show, right, Before the Bell. You can subscribe to both of those YouTube channels. Our newsletter has its own email list, so if you just want the newsletter, you can subscribe to that newsletter, and that's the Bull Bear Report. And then, of course, we have our daily market commentary we send out every morning by 7:30 in the morning. That is also its own separate email list. So lots of things you subscribe to. Just pick the ones you want, and we'll make sure they get delivered to you on time. The part of the and then there's a few blogs we write that don't get sent on newsletters. Those are on the website, and this is one of them. But the pain trade is a function of the fact that we have so many people being so bearish, right? Everybody is bearish. Bearish sentiment is off the charts in a lot of cases. A lot of investors very underexposed. And then when markets do eventually bottom and start to run, everybody's got to scramble to cover. And this is what causes these kind of stronger bull market rallies that we have and have been seeing ever since last year. And, there's some things that are setting up now that suggest that we may be in another one of those phases where you have enough people that'll be forced back into the markets through short covering, et cetera, that you're going to see you could see a fairly, everything's always a guess, but you could see a fairly substantial rise higher here in market short term. And there's a few reasons for that. Now, does this mean that the world is all healed up? No, of course not. We still have lots of problems, right? The economy's slowing down. The Fed has still hiked rates. We haven't seen, a lot of those impacts hit the markets yet, and it certainly could lead to a more volatile year in asset prices once again. But there's a couple of things that we do need to pay attention to. One is that if stocks are down, and Brent, I have a chart. Brent's going to help me out here in a second. But if stocks are down in the preceding year, right, that's one thing. And then you have the Santa Claus rally, which we had just barely. And then you have the first 5 days of January, which typically suggests that you have a strong January in total. Then that historically has had 100% rate of growth in that following year. So 100% of the time that you've had this trifecta of events, a negative year, Santa Claus rally, first 5 days of January rally, that has always led to positive outcomes in the year. It's like, oh my gosh, how did that happen? And by the way, those typically tend to be fairly strong rates of return, usually double digits. Lance, that's impossible. That can't happen. We've got too many things that are still going on. Maybe. I'm just telling you what the statistics are. And yes, this time could certainly be different. The one thing about statistics is that if you have 100% probability of something, eventually it's going to fail, right? So maybe this is the year that it doesn't work out. But the probabilities are and have been that typically portends to a better year. Now, again, what's causing the rally right now? Stocks have rallied. They're above their 200-day moving average. MACD buy signals are in, et cetera. This is all predicated on a few beliefs that you have to think that are going to come to pass. One is the Fed's going to pivot and start cutting rates, that the economy is going to avoid a recession, that yield curve inversions, and we have a chart on that as well this morning, that yield curve inversions, which, by the way, we have 90%. So of the 10 yield curves that we track on a regular basis, and these are the economically most significant, 90% of them are now inverted. We're not to 100 yet, but real close. But 90% of those curves are inverted, and when you have 90% of the curves inverted, that has typically led to a further market decline, right? And usually the yield curve inversions marks the peak of the market. They usually don't come after the peak of the market. So that's one difference this time that may render this indicator a little bit less effective. We'll see. They also the market also believes that the housing market's going to remain robust, that we're not going to have this massive decline in the markets. Employment will remain strong, of course, and that suggests that households will be able to continue to spend despite inflationary pressures, and of course, most importantly, corporate earnings and profit margins will remain strong. That's the underlying story that is supporting this market. That's the bullish view. Now, again, there's lots of things to certainly weigh against that, but there's also some technical setups that are becoming a little bit more important here because, we're starting to see improvement, and this is all short-term stuff now. Now we're talking about the pain trade and what that could be, and that could be a couple of weeks to a couple of months. After that, I've got there's no clarity. Too many things can happen. But net bullish sentiment is still extremely bearish. It's improving, right? But it's very bearish. And and again, when most investors are bearish, they're usually wrong. And again, that as markets start to rally, that begins to pull investors back into the markets. But importantly, we have some technical developments that are much more important. When markets are topping, we talk about head and shoulders patterns like, oh my gosh, this portends to a bigger market decline. And we had that last year. And that did lead to a bigger market decline. Now we have the opposite of it. It's called an inverse head and shoulders. Now, we haven't completed this pattern yet, but it is improving. And if we can get a break above the downtrend line from the January highs, and then again from this neckline that's the previous market, kind of this inverse head and shoulders, kind of the bottoms, we could potentially see a move to somewhere around 4,250 to 4,300. So it's a decent move higher. Now, it's not going to get you back, right, to where you were last year. It's not going to recover your losses, but there's potential here for a larger move higher from a technical perspective. And again, when we take a look at kind of the market as a whole, there has been this kind of drawdown of the markets. There's this very clear downtrend line from the January peaks that runs right along the 200-day moving average, which is right where we're challenging right now. So if we get above that, and we've got the buy signal in place right now, if we get a move above that downtrend line, there's not a lot of resistance to a move higher to around that 4,300 level. And that's going to surprise a lot of investors. And then they're going to start scrambling to get in. And as they start to scramble to get in, that's going to push asset prices higher. And then potentially we'll have to deal with a slowing economy or whatever it is, later on this year. But this is that kind of bigger setup that we're talking about. And again, there's, a lot of things that have to happen, for the bear market, so, to speak of, is to be over, right? We need to see improving earnings. We need to see these type of things. We need to avoid a recession. And look, there's no guarantee that we're going to do any of that. But right now, that's what the markets believe. And so you have to separate out. This is one of the email challenges I get. And, every week when I, do the video with, Adam Taggart, right, get a lot of pushback. It's like, the world's coming to an end. I need to be in a bunker. I need to be cash and gold. And there's nothing wrong with that, right? But you've got to be careful of it because this, what we've been in will end. And the question is has it ended already and we're now in the process of improvement, or is there still more to go? And nobody knows the answer on this, right? We can all guess at it, but the end of the world doom and gloom theses tend to turn out wrong more often than not. And one of the big drivers this year is going to be share buybacks. Corporations have had a record issuance of share buyback announcements this year, 1.2 trillion. Hear me clearly. Share buybacks have accounted for 40% of the gain in the market since 2011. $1.2 trillion in announcements for this year already is a record. And that is $4.5 billion a day in share repurchases all year long. Every single trading day, $4.5 billion going into the markets. That's a support for asset prices that may keep things a bit more bullish than a lot of people think. All right, when we come back from the break, let's talk about debt, right? That's the big concern here. We're all going to die because of the debt. We're not, but we'll talk about when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Housekeeping.
Getting your financial house in order for the new year need not be a tedious task. Our next Candid Coffee will get you ready for the fiscal roller coaster 2023 promises to be, with financial tips and talk. Saturday, January 28th with Richard Rosso and Danny Ratliff. Register now at realinvestmentadvice.com. The Financial Housekeeping Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Just want to give you the exact definition for job security. Brent had to be out yesterday to take care of his lovely wife. I can't do a show without him. So, that's what you call job security.
The Real Investment Show podcast. Same show, your schedule.
He's going to be like a weekend at Bernie's. If he ever dies, I'm just going to have to prop him up in a studio so that we can do a show for you in the morning.
At realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Financial Housekeeping Candid Coffee with Ratliff and Rosso will get you ready for the fiscal roller coaster 2023 promises to be, with financial tips and talk. Saturday, January 28th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, the next big event, right? Congress poised for showdown as U.S. hit debt limit this week. The world, we're all going to die because of all the debt and the debt ceiling, and we're going to shut down the government. Look, it's, do we have a debt problem? Yeah, no doubt about that. And, the problem that we have is obviously that we just have too much spending versus, too little revenue. And, despite the fact we're running record tax revenue right now, we just simply have no control over spending. We just, have to come up with more and more reasons to spend money on stupid things that, don't produce revenue. And look, one of the reasons that we are trapped in a slow growth economy is because of the debt. Debt detracts from economic growth. And there's a very clear correlation going all the way back through history on this. In fact, every country in the world. And when you surpass 100% of debt to GDP, which the U.S. has, then, you're going to have slower growth. And it's just really kind of a function of math. But it doesn't mean that the world is going to end and we're all going to default and be bankrupt. And there's a very good case study for this. It's called Japan. For 40 years, Japan has been running massive debt levels. Do they have problems? Absolutely. They're trying to do yield curve control right now. They can't raise interest rates. They have rolling recessions every 3 years. It's not great to be in Japan. But they're still here and they're still kicking, right? And this is after 40 years. So my point about this is debt a bad thing? Of course it is, right? Too much debt is not good for the economy. And that's just kind of common sense logic. But does it mean that we're all going to default and the world's going to come to an end as we know it, and that's going to happen tomorrow, by the way? No, that's not what that means. I get a lot of emails from people like, well, aren't you worried about the debt? Well, yeah, I am worried about the debt. But it's got no impact or bearing on the markets right now because the markets don't care about it at the moment. Does it have long-term economic consequences? Yes. I'll be dead, and so will you. But yes, there will be economic consequences as we continue to go down the path of Japan. And I've written articles called the Japanification of the U.S., right? And we're on that very same path. Aging demographic, rising debt levels, runaway spending, no controls in government. I mean, we have very much a very similar pathway as Japan. Yes, there's some differences, but we are on a very much a similar pathway. Our saving grace right now is that we have the ability to print our own currency, and we have the benefit of being the reserve currency of the world for now. That too could change. I'm not sure where or how it could change because where else are you going to put your money? But for now, the U.S. remains the dominant currency. And that gives us some unbridled benefits that other countries don't have. So is the debt a problem? Yes, it's absolutely a problem. Is it something that you should go hide everything in, your bunker with beanie weenies and your gold bullion and ammo because this is all going to crash and die tomorrow? No. The problem is that you can run very high debt levels for a very long time before they become problematic. Now, it could be tomorrow. Could be. But probably not. And so when you're investing money, and again, this comes back to, I don't really care much about anything else, except investing money. That's kind of the thing. So it's important. And look, I don't mean that by saying I don't care about them because I do, but that's a different conversation, right? If you want to have a political conversation, we can have a political conversation about the malfeasance of government, right? So that's a different story, though. When we're talking about right now is the impact on the markets and our investing. That's why you're listening to the show, is what to do with your money. That problem will have no bearing on the market short term. And so if you're investing based on this thesis that the world's about to go bankrupt, you're going to probably wind up missing out on a lot of market returns by being in the wrong asset classes. And that's the important thing to understand. And again, there's a lot. Look, and the debt is a great piece of headline making kind of agenda for getting clicks and views, and people send me links to videos about the end of the world's coming because of the debt. The dollar's going to collapse because of the debt, and this is going to happen because of the debt. And the only thing that's going to save you is going to be Bitcoin and gold, whatever. Be careful with that. I'm not saying it's not going to happen, right? I'm just saying be really careful with it, because whenever we get into these scenarios where there's the doom and gloom prediction, the end of the world, the bust, whatever, something else tends to happen. And I'm the world's worst about predicting the worst possible outcome. If my son calls me and says, "Hey, Dad, I got to talk, but I can't talk right now. I'll call you later." I immediately jump to the fact that he's in prison and, he just, that was his one phone call and I got to go bail him out. Turns out that, he just wanted to tell me about his day at school. But for me, it's the worst possible outcome, right? Always. I mean, that's where I go mentally. So, the problem when it comes to investing is you can't do that. Because if you do that, you're going to wind up missing out too much on returns and growth of your capital over time. So it's important to keep these things into some perspective about how they actually physically operate within the economy. Look, the debt's a problem. The reason debt is a problem is because we have to service that debt. with interest rates higher right now, that is taking more tax revenue to service the interest payments on the debt. So that takes money that we could be using to fund productive investments, nuclear power plants or, hydroelectricity generating dams, those type of things that we could then charge fees for that would produce a revenue stream that would pay them for themselves over time. We could be spending tax dollars on those types of productive investments that would lead to stronger economic growth over time. But instead, we have to spend those dollars on paying debt, which is a one-time benefit. So we don't get the benefit of those reinvested dollars into a stronger economy. So that leads to slower economic growth over time because we keep extracting more and more capital from economic growth to pay for debt. And this isn't just government debt. This is household debt is exactly the same thing. The economy is 70% consumption. With consumers running record debt levels, that means more of their dollars are going into paying for debt, which means less money to go back into the economy, which means slower economic growth. So more debt, slower economic growth. That's what you're going to get. And this is why Japan has very slow economic growth. They have rolling recessions every 3 years or so. Can't get interest rates off the ground because of exactly that reason. We're heading down that pathway, right? We're going back to sub 2% growth over the next few years. We're going back to very low rates of inflation. We're going back to very low interest rates because you can't support economic growth with high interest rates. You've got to have low interest rates in order to support slow economic growth. Because there's just too much debt that has to be serviced. And the economic growth that we're getting is all coming from debt generation. It takes more and more debt to generate $1 worth of GDP. So that's a problem. But it's not a problem today. Now, the debt ceiling, as I said earlier, is more political Kabuki theater than anything else. There is zero members in Washington that want to actually have a debt ceiling. They want to use it for a political pawn game to try to leverage some concessions on raising the debt ceiling for whatever that is going to be. But they all want to raise the debt ceiling because they know they have to, because they're going to keep spending money. It doesn't matter which party you're talking about, either Democrats or Republicans. They both want to spend money. It's just a question of what they want to spend money on. And they all want to spend more money than we have coming in revenue. And the reason is because the revenue that we generate from taxes, it takes 100% of that revenue just to pay for mandatory spending, Social Security, Medicare, Medicaid. They're not going to touch that. Military spending in terms of payrolls, right? Not defense spending, but actual payment of our military. That's a mandatory spending. And interest on the debt. Outside of that, everything else is non-discretionary. That's the stuff they want to spend money on. That all has to come from debt. So they all want to spend money on debt. They all want to raise the debt ceiling, right? So there's nobody that wants to live on a balanced budget. Now, the one thing that we may eventually get to is running a budget to where we don't automatically have, we'll get back. We won't have baseline budgeting. I'll spit that out. Where we just don't automatically increase the budget 8% every year, which we've been doing for decades now. So maybe we'll get there. Maybe we'll get to some point of running a balanced budget at some point. Who knows? Right? I'm optimistic. I'm also optimistic that we're not going to have a debt crisis tomorrow. So be careful, is my point, about investing on that thesis. Be right back after the break.
All the things you say, none of it comes true. Met with a guy in LA. Good for you, it's all about
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
House housekeeping.
Getting your financial house in order for the new year need not be a tedious task. Our next Candid Coffee will get you ready for the fiscal roller coaster 2023 promises to be, with financial tips and talk. Saturday, January 28th with Richard Rosso and Danny Ratliff. Register now at realinvestmentadvice.com. The Financial Housekeeping Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So this morning, a few things that are going on as we kind of get earnings season out of the way. Morgan Stanley, Goldman Sachs, both reporting earnings this morning. Morgan Stanley out of the gate with fourth quarter earnings results. Profit fell on deal making. Of course, not surprising. IPO market was really under a lot of pressure last year after 2020, 2021. When we were doing SPACs and IPOs like crazy. As money dried up and markets fell, nobody was really interested in buying IPOs of companies. So not surprising that deal making fell. Profit down 40% to $2.2 billion from $3.7 billion a year ago. That amounted to $1.26 per share. That topped estimates of $1.25. Now, this is the important thing I'm telling you about earnings, and pay attention to this. This is millennial earnings season. We lowered the bar on earnings estimates ever since June of last year. We've been dropping earnings estimates so these companies can beat their earnings. Okay? They're beating much lowered expectations. Now, what's going to be important is what they say about the future, right? But right now, everybody's going to get a trophy because we're all have lowered that bar so much that everybody can get over it. So, $1.26 per share, that topped estimates of $1.25. That was what Wall Street, according to a FactSet. Revenue was about $12.7 billion. That was above estimates of $12.5 billion. Again, down from $2.2 billion in profit, right? So, down from $3.7 billion a year ago in profits. So big drop in profits, but beating earnings, beating revenue. Goldman Sachs also announcing earnings this morning as well. Goldman Sachs Group is making their announcements. Profits down 66% to $1.3 billion from $3.9 billion a year ago. That amounted to about $3.32 a share. Revenues about $10.6 billion. That was a little bit below expectations of 10.76. Again, deal drought, just like, not surprising, just like with Morgan Stanley, is what's dragging on revenue, right? Investment banking is where these companies make all their money. What is investment banking? That is where they, develop product to sell to you. And so when you have a big demand for a product and you're wanting to buy everything that people are willing to bring to markets like you were in 2020, 2021, bankrupt companies or not, they're going to make a lot of revenue. Well, when that's over, revenue is going to fall. That's just a function of their business. Their business model is to develop product and sell it to you at a fee. That's how they make money. Stock and bond trading revenue up 18% thanks to volatile markets. Provisions for credit losses were $972 million for the fourth quarter. That was up from $344. Now, there's an interesting story developing in the banks. Loan loss provisions are rising sharply across banks. They are preparing for defaults, loan defaults, credit card defaults, mortgage defaults, those type of things. So they are preparing for that. Now, here's the trick about loan loss provisions. Take Goldman Sachs as an example. So they move money over to 900. They move money into loan loss provisions, right? So that's an expense to the books. Later this year, if they don't need to use those loan loss provisions, right? So they set money aside to take care of potential mortgage defaults, credit card defaults, etc. Let's say the worst does not happen. And let's say they only have $472 million worth of loan losses they've got to deal with, but they've got 972 sitting over there. They then bring that $500 million that's sitting over here back on the books. Guess what that is? That's revenue on the books, right? So they'll say, oh, we had a big jump in revenue. Well, $500 million of it was just bringing back loan loss reserves back on their books. So again, just pay attention to this because there'll be some funny business that you'll have to sort out later this year. Bitcoin is also trading higher. I'll see if I can get you the exact number this morning. But Bitcoin's actually finally gotten a little bit of life. Not surprising because after the whole FTX collapse last year, et cetera, so forth and so on, you're starting to see speculative investments go back up in price. People are starting to chase speculative stocks like Marathon Digital, which was just a couple of weeks ago. This stock was trading right around $2 a share. It's now $7.88. Right? So big surge in these very beaten up, basically near bankrupt companies as fears of the worst are now starting to fade away. Bitcoin's trading up near 21,000, actually over 21,000 right now for Bitcoin, up from 14, 15, 16 just a few months ago. So you're starting to see a lot of speculative investment come back into the markets now that people are starting to fear or starting to come to this idea. And this is why that pain trade is higher. You're now seeing a very different rally now than you've had previously. And the bear market rallies we had in 2022, you had markets rise 10, 11, 12% on stocks, but the junk stocks didn't rally that much. And Bitcoin didn't rally at all. Now you're seeing the most speculative assets really come back into the markets as people are now starting to speculate that the bottom is in on a lot of these assets. And so it's a little bit of a different rally that we have today than we've had previously. China's economic data also giving a little bit of support for markets. Let me just read you the headline and I'll tell you the true story. China's economic growth slowed sharply to 3% last year under harsh COVID-19 control measures, but fourth quarter growth was 2.9%, which beat estimates of 1.7%. The contrast, of course, reflects the challenge of investing in China. There are plenty of reasons to be bullish, including reopening of borders after 3 years of tight COVID controls, easing pressure on technology sector, government moves to address the property slowdown. Again, credit impulses. Now, just to remind you that China is a state-run country, and they tell you what their GDP number is. Here's the difference between the U.S. and China. The U.S. reports GDP on a quarterly basis. So in January, we report GDP for the fourth quarter of last year. In February, we'll revise the first quarter estimate. In March, we'll revise again the first quarter estimate. As data comes in, we revise that estimate. 3 years from now, we'll go back and revise all the data after we have all the data in and we can see clearly the trends and what the data is. So there's a constant revision process going on with U.S. GDP growth over a 90-day period and a 3-year period following the actual quarter. China reports GDP 15 days after the end of the quarter and never revises it ever again. That's because they just tell you what GDP is. How can a country that has been locked down for as long as they have been have surging economic growth higher than it was a year ago when they weren't locked down? Go figure that out. But nonetheless, China reported very good growth. And if we only had that kind of, ability to report things.
It's like, yeah, whatever.
Yeah, it is what it is. PwC resigns as the Evergrande auditor. Remember that, going back to China, China's got a huge real estate problem. Evergrande was one of their real estate companies that were building. You remember the whole story about China is they were building these entire cities. That they built Manhattan as an example. They built cities. They built entire cities in China that nobody actually lived in, but to generate economic growth, they just built these cities. And a lot of them were empty, vacant, never lived in, etc. But entire cities existed. Evergrande, part of the big real estate property developer, of course, it was the one that went into bankruptcy, had to be bailed out. PwC, PricewaterhouseCoopers, was the auditor for that, and they have now resigned as the auditor of Evergrande, citing, quote, a lack of information. Never mind the results for the year just ended. Evergrande's creditors are still waiting for 2021's financial statements. They will have to wait even longer after auditor PwC has resigned. Evergrande was once China's biggest property company, almost collapsed under a mountain of debt. It is now in the middle of a complicated and lengthy debt restructuring. In its resignation letter, PwC pointed to a lack of information from Evergrande on a range of subjects, including possible off-balance sheet liabilities, the value of the property portfolio, and the status of some outstanding debt. Evergrande has hired a new auditor that is a Chinese company, and they said they will be filing everything on Monday. So I'm sure we will get perfectly pristine information coming out of Evergrande soon as chief executives disappear into somewhere. Exactly. Anyway, all right. So those are kind of some of the bigger headlines of the day. Anyway, that is make sure and get by our website. Again, let me just remind you, kind of house cleaning again. Just we'll do this here until we get everybody kind of switched over. Before the Bell, which will be coming up here in about 30 minutes, is our 3-minute video. Previously, we called it 3 Minutes on Markets and Money. It's now called Before the Bell. That now has its own YouTube channel. So you'll need to subscribe there to get notified daily when it comes out. You can also link to that through our Real Investment Show YouTube channel as well. The link's also on our website, realinvestmentadvice.com. Make sure you also subscribe to our daily commentary. That's a separate email list, along with our weekly newsletter, the Bull Bear Report. That is also a separate email list. Keep you updated on everything that we're doing. Our latest blog post is out on the website now. The pain trade is higher with all the attenuating charts and graphs. That is there for you. Also, have a great day. Tune into Fox News at 2 o'clock this afternoon. I'll be hanging out with Charles Payne for a few minutes. Talking, and there goes the market. Market crashes every time I'm on Fox News. Anyway, we'll be there this afternoon. Have a great day. See you back here tomorrow.